You might not want to wait until the end of the year to think about your charitable donations. If you're a professor, physician, or administrator who donates to charity, there are new rules in 2026 that could significantly change how much of that giving is actually deductible. Let me break them down. Congratulations, you filed your taxes, reviewed your charitable giving, and maybe for the first time in years, you are actually able to itemize your deductions. That's great. But starting in 2026, there are some major changes to charitable donation tax rules that every taxpayer needs to understand, especially if you give to charity on a regular basis. And depending on whether you itemize or take the standard deduction, the strategy may look very different. Let's walk through the three biggest changes. Number one, new limit on itemized deductions. If you're in the highest federal income tax bracket, the 37% bracket, the value of your charitable deduction is now effectively capped at 35%. What does this mean? It means your donations still count in full, but the tax benefit is slightly smaller. For example, let's say you make a $10,000 charitable donation. Previously, if you were in the 37% tax bracket, that donation could generate about $3,700 in tax savings. Under the new rules, that tax benefit is now at $3,500. Not a huge difference, but still meaningful, especially for high income households making significant charitable gifts. The key takeaway here is planning. You may want to work with your financial advisor and CPA to reduce taxable income through strategies like maximizing retirement contributions, tax efficient withdrawals, or income deferral strategies, because the less income exposed to the top bracket, the better. Number two, the new 0.5% AGI floor for itemizers. This is the bigger change for most people. Starting in 2026, if you itemize deductions, you can only deduct charitable donations that exceed 0.5% of your adjusted gross income, your AGI. Let me explain. If your AGI is $200,000, 0.5% of that is $1,000. That means the first $1,000 of charitable donation is not deductible. Only the amount above that threshold counts. So smaller donations may no longer reduce your tax bill the way they used to. This creates an important planning opportunity. One strategy is called bunching. Instead of donating every year, you may combine 2 or 3 years of charitable giving into one tax year so you can exceed the deduction floor and aim to improve your after-tax outcomes. Another strategy is to look beyond cash donations. Donating appreciated stock, real estate, or other highly appreciated assets may help you clear that threshold while also avoiding capital gains tax. That can be a very powerful planning tool. Number three, new deductions for non-itemizers. Now, for some good news. If you take the standard deduction, you can now deduct charitable donations. Single filers can deduct up to $1,000. Married couples filing jointly can deduct up to $2,000. This applies to cash gifts made to qualified operating charities. One important note, this does not apply to donor advised fund contributions. But for many families, this is a great opportunity. Especially if you don't itemize, you could still lower your tax bill while supporting causes you care about. And if you're already charitably inclined, you may want to consider maximizing that annual amount. Also, don't forget to check whether your employer offers charitable matching programs because that can significantly increase the impact of your giving. Final thoughts, retirees and QCDs. And one final reminder, if you're age 70 and a half or older and you have IRA accounts, a qualified charitable distribution or QCDs may still be one of the most tax efficient ways to give. Instead of writing a personal check, you can donate directly from your IRA. This reduces taxable income directly and may create a better tax outcome than relying on itemized deductions alone, especially now with these new rules. Bottom line, 2026 changes charitable giving strategies in a big way. Whether you itemize or take the standard deduction, proper planning matters. Don't wait until tax season. Review your charitable strategies before year end with your CPA and financial advisor, because a little planning can make a big difference. This content is for general educational purposes only and does not constitute tax, legal, or financial advice. Please consult your CPA, tax advisor, or financial planner before making any decisions. Investment advice offered through Stratos Wealth Advisors, LLC, a registered investment advisor. Stratos Wealth Advisors, LLC, and Emeritus Wealth Partners are separate entities.